Imagine this, you have just listed your beautiful condo or vacation home on Airbnb. Bookings are pouring in, the extra income feel amazing. And you're thinking this is the best decision I have ever made. But hold on, what happens when tax season roll around? So if you're earning income from short-term rentals, there is more to it than just hosting happy guests. Starting Jan 1st, 2024, the new rule short-term rentals will be in place that could significantly impact your taxes. So let's explore these changes and stay top of it. So what consider as short-term rentals? Any property that rented less than 90 consecutive days. And with its gaining popularity, the government has decided to introduce new rules to ensure compliance and proper taxation. Under this rule, if your property doesn't meet local registration, licensing, and permit requirements, the CRA will deny the expense deductions. And depending on how you operate, it can also trigger the HST applications. Before we dive into example, let's explore one more important point, the 2024 grace period, which means if your property becomes compliant with all registration and licensing requirements by December 31st, 2024, it will be considered compliant for entire year. This is a big opportunity to avoid penalties and save on your deductions. Let's understand this with a practical example. We have Maya, who owns a cottage in Ontario, and she started renting this property as a short-term rental in June 2024, from where she earned income of $18,000 and she was having expenses of $12,000, which was ultimately making her net income of $6,000. Sounds right, but here is the catch. Maya didn't register her property by December 31st, 2024, which make her rental property as a non-compliant under the short-term rule. So here is the formula that how CRA will calculate the non-compliant amount. A into B divided by C, where A is the total deductible expenses, which is 12,000 in Maya's case. B is the number of non-compliant days, which is 214 from June 2024 in Maya's case, and C is the total number of rental days, which will be also 214. So after this calculation, this 12,000 of expenses will become non-compliant, which leads her to 18,000 of taxable income instead of 6,000. And if we are taking into a bit further, imagine if Maya has a marginal tax rate of 40%, so she will be paying total 7,200 of taxes on this taxable income instead of 2,400 which she was initially expecting. So moral of the story, that she would be paying 4,800 extra just because she didn't meet the compliance requirements. So that's all for today's video, and if you still have any doubt about short-term rental, you can drop your comment below and follow Textron for more tax updates.